All right. Good morning, everybody. It's options expiration day. Happens on the third Friday of the month, every month, unless there is an event like a holiday or something. Meta triggered through its put wall yesterday. It would set off one of the alerts from spot gamma. You can see the put wall at 302, and it came down and fractured through that level. Managed to hold, but it's just interesting. Thought I would put it out there. US dollar Japan is getting a little frisky this morning. If I zoom out here a little bit, you can see the exaggerated move. This is a 15-minute chart. Textbook picture of a bull pennant. That was a failed rising wedge breakout. See, it was supposed to come up and maybe Busby off the bottom and then fall back down, but instead it actually came completely back inside, and it negates the entire thing. We just take it off at that point. Rising wedge is a pattern that doesn't fail very often. So I was a little surprised. That's because Bank of Japan's stance on the yield curve control. Remember that they have a new governor at BOJ. And a lot of the world is concerned about what that's going to mean going forward. You know, he said a lot of things about maintaining the status quo, but he could say whatever he wanted until he finally got elected. And now that he's got the seat, well, I mean, he's steering things so he can go where he wants. One of the big things yesterday when we were looking at forward future rate hike projections before 8:30, the September anticipated rate hike policy change was going to be no change. It was going to be right that they were going to pause for September. At 8:30, data came out and they suddenly started changing their projections. The swap rate or the Fed swaps started pricing in another hike for September. So if you go to Fed Watch, remember yesterday morning it was at 14 for September. And now it's at 16. And that might not seem like much, like, you know, it's only 2%, but it has to start somewhere, right? Now, it is also interesting that this one in the middle went up as well. It went from 81.5 to 83.9. But that's not much of a change from where we were 1 week ago when it was at 83.6 and now it's at 83.9. Yeah, that's not much of a change. But on this one over here, where we're looking at a 25 basis point rate hike for September, it went from a 13.5 to a 16. So it's a good start, right? And a month ago, we were at 11.9. So the idea that we could get a rate hike in September is starting to grow, right? They're planting the seeds and watering that thing and seeing what they get out of it. Remember, the Fed doesn't like to surprise, and one of their stated goals is to clean up and better improve their communications. So they're going to start talking about this early and often if they really are going to start pushing for that September rate increase. Looking what's going on in global markets, it certainly makes sense. We don't really have a lot on the agenda today or on the table. There's earnings and there's OpEx, options expiration. It's more about next week, right? We got manufacturing PMI, we got the FOMC next week. And if that's not enough, we also have jobless claims next week. So that's going to be a really big deal. On the things that were left for the month of July, two of the biggest things is today's options expiration and next week's FOMC. That's how high today's OpEx has been ranked due to all the gamma positioning and all of that other stuff, right? So how we end today is going to be a really big deal. And although we started this week with the idea that we were going to be range bound, and that didn't really play out that much, we're going to be starting next week with the same bias that we're going to be range bound on the anticipation of FOMC Wednesday, and that who would want to make big changes to their portfolio right before an FOMC announcement, right? Think about those institutions or the firms and the CTAs and the volatility control funds. They don't get to choose, right? Those VC funds, they have to buy or they have to sell based on what volatility is. They don't have the discretion that you and I have to pick and choose. And the CTAs, same thing. They've got these levels. And if the market stays range bound, they have to buy or sell those levels. If the market rallies or if the market falls, they have to buy or sell levels. They don't get to pick. So, you know, their hands are tied. Looking at what's going on around the world, Hong Kong is up the most and their markets are closed, right? So we'd be looking at the futures. They're up 0.75% and continuing to increase. It says US tech, we just look at that as the NASDAQ, up 0.5%. Then we could see the S&P nearly 0.25%, and the Russell also around 0.25%. Europe is basically flat, and Japan is down more than 0.5%. It does show a slight anticipated impact for some data today, but really it's going to be OpEx this afternoon for the big one, right? All right, we are primed and ready for a surge play. If you lay out the moving averages, and use something like 4, 10, 20, 50, 200, then price crossing back above the 4 is the start of a surge play. You can see back here on the left side of the chart, when we were underneath that cyan line is the 4-period moving average. So we were underneath it, struggled to get through there, finally got through and needed to prove it, and then away we went. Right, same thing here, pulled back to the 4, pulled back to the 4, got above it in the surge, right? We broke through it. We might maintain it another day or two still, right? It doesn't owe us a crossover. But that cross back above is the start of a surge. The 4 is already above the 10, so we don't need to wait for the 410 cross, which is what we had back here. A much better play, right? 4 just crossed under the 10, price was under both, had a 410-20 bounce basically right there. Price crossed over everything, the 4 crossed the 10, and away we went. And you know, we're looking at 44.50 up to basically 45.50 to nearly 46 in that one straight shot. We have not moved too far, too fast. Still, because we continue to get these good, healthy pullbacks. The red lines, really thick red lines here, are from spot gamma. This is today's updated spot gamma levels. We're underneath them. The orange dotted line here is the weekly expected move. We're back inside the box. We don't have a missed daily pivot from today, but we do have one from yesterday, right? We never did make contact with that thing. And there's still one from Wednesday, oddly enough. We didn't really get a move through the kill zone this morning. And while we have a very narrow IB, the expansion out of it, right? We can measure that. It's like we've gone 3 or 400% of that narrow IB. %, maybe it's only 200. Yeah, we've gone more than 200% of the IB already. Volume is really light if we're looking at the cumulative overnight volume. That makes sense with OpEx on the table today. We would have anticipated they were already repositioned, right? That they've changed their holdings. $10-day, 30-minute volume profile. By Monday afternoon, unless we go back down there, we're going to lose this volume down at the 44.11 cog line. Once that's gone, we're going to start seeing the bottom of this volume profile inch up each day. And it's going to become narrower and narrower unless we expand out of the top or we come back down and break that bottom. We still don't have a classic shape, but what we would end up with is a D shape by Tuesday afternoon, maybe Wednesday, right? Because if all of this is gone by Wednesday, then we would just have this classic D shape here with the point of control most likely in the middle, right? Depends on how much longer we hang out around that weekly expected move. It's interesting at this price, how much volume there was and how little time we spent at that location. We can see the TPO in blue. It looks like a volume profile, but it's a TPO. Right? Volume profile is volume by price, while a TPO is volume by time. We spent a negligible amount of time where that yellow line is that I have drawn. And yet we've got a significant level of volume there. Just shows they were, actively engaged at that high. Very likely hit a ceiling. If it had been, along the lows, we'd call it an iceberg. We do have an air pocket down here, but, unless we break some really key levels, it's unlikely that we're going to get down to that 4,500, which is still the shallow zone, right? Oddly enough, I don't even know what to do with that. We have a VPOC from yesterday. It's been hit. Now the argument can be made, do we keep it? Or now that it's been hit, do we take it off the table? In a situation like this where it's barely been tagged, or it's been tagged in the Globex, you could argue that you want to wait for it to get hit again in the intraday. I tend to leave these on all day, and the next day when I'm doing my morning briefing, I then remove it, right? That way I can see how price responded at that level all day. I'm not using it for any sort of trade insight, right? I'm leaving it on there to see how price responded around those levels. So if you're using it as a VPOC, remember the V stands for virgin, untouched. It's been touched. It has no value to you if that's the only thing that you're using it for, right? If you're using it more for insight or analysis perspective, then leave it on, right? Leave it on until the end of the day and see if price really does react at that level again and again. When I do take it off, it's usually because of something like this right here. So, that was the point of control from the previous day. We spent all night just chopping back and forth through that zone. There's no value to that thing at all at that point, right? Just take that thing off the table. I don't even wait. Don't even worry about it. But on a day like this, where we've barely interacted with it at all, and now we've pulled away from it, if we make another run towards that Globex high, I want to see how price reacts at that volume profile level. So I leave it on. Even here with this topping pattern on Wednesday. Well, that's a bad example because that's that day's point of control. So never mind. Never mind. It's going to have a discussion on that, but nah. Every Friday, we get a new box. And that's no different here. We have next week's range projections already started, but it's not set in stone yet. Right? Remember, this is the static expected move. You can always use a dynamic one, the one that changes constantly. Every minute it's changing. Mobius coded this the best that he could, but on Thinkorswim, you don't have code language to access the data that we need to access. And this is what it's accessing here. The implied volatility average within the options chain. There's no Thinkorswim code that can give you this. So he did a really great job with what he had, but hand drawing the lines are way more accurate than using that indicator. Another thing to keep in mind is the indicator was designed for the SPX itself. Because of the hedging and positioning and activity of the institutions within the SPX, that's why the whole darn thing was even started, right? Otherwise, why would we care what the range is from 1 week to the next? We would want to know what the immediate right now range is. How far could we go between now and next Friday? And then, an hour later, ask the same question and check again and again and again. So hand drawing the lines will always be more accurate because you can actually access the data that this indicator can't. In times of volatility, this thing is way off. Like right now, it's not so bad because volatility is not so bad. It's a negligible miss. You wouldn't want to go in and hand draw the lines on, say, every indicator in your watch list, right? That would just be nuts. And that's why this indicator is still so useful and so valuable. If you do want to draw them by hand, wait until after 4:15 p.m. on Friday afternoon, anytime on Saturday, and on Sunday, watch the numbers. I think the numbers start changing again on Sunday during the day, but definitely after 6 p.m. on Sunday, it's too late. It's already started to move again. Those numbers being these numbers here. Once this thing sets into stone today at 4:15, it won't move again. Like last week's, once it was set, it didn't move. Stocks generally stay inside the range 70% of the time. That's a 1 standard deviation. The S&P has a history of 80%. My very basic, simple approach to know if we're breaking that 80% number is just count back over the last 10 weeks. How many weeks have we closed outside of this box? 2 out of 10? Well, there's my 80%. 3 out of 10? There's my 70%. If we've closed outside of this box more than 3 times in the last 10 weeks, then I know the market makers are really getting it wrong. Surprisingly enough, that's usually when things start to unravel. Right before COVID hit, when we were sitting at all-time highs, the market broke out of this thing and closed outside of it repeatedly right before COVID. There was a warning that something was coming on and we couldn't quite see what it was, right? And of course there was a global shutdown, but a lot of people, didn't make it through there. So it's a warning, counting back, keeping track of it, right? The other thing that we use it for, even though it's not set yet today, we can kind of get a glimpse. What are the market makers doing with volatility? Are they inflating it? Is it expanding? Or is it, compressing? Is there less of it? Are they unwinding some of it? Looks like they're pricing in a little volatility. Now, this isn't set in stone yet. We want to revisit this later, say at the end of the day, and see how wide it is compared to the previous week. But those are just some things that I use it for on Friday morning before it's set in stone. If we do continue to rally today, we still expect to stay inside this range. So we could peak outside the box, but we'd still expect to come back inside the box. I have that line drawn here, although you can't really see it with all the other mess that we have. So we'll just kind of shut some of this stuff off. There's the orange line, the weekly EM. $45.89. So if we do rally back up and we poke outside of that box, we're still going to expect to come back down inside of it. We have a voodoo line at 45.78. ADR half, 45.85 and 46.04. Call it 46.05. If we break yesterday's low, the target's going to be that 10 DMA, the 10-day moving average down there, 45.42. It'll be a little beyond the ADR half. And we do have a market maker move this morning. Remember, I mentioned the volume was light. Put those two bits of information together. We have light volume and we have a market maker move. Not only are they sitting on the sidelines this morning, not participating, they've already started hedging. They're getting ready for a move, and it's today's, right? If it wasn't today's, then this market maker move wouldn't show up. So they're hedging in the front. They're hedging today. They're looking for a big move, an outsized move, maybe a little bit like a gotcha move. So that's a nice warning to have this morning, right? We're not going to be caught blindly off sides because we got a little bit of a heads up. Now, we don't always know what they're positioning against, but we do know that they are looking for either a rug pull gotcha moment or a rocket ship where we run up and break the current high of the week. Get a weekly breakout. It might very well have something to do with what's going on over in Japan with this US dollar Japan move. We got this nice rounding pattern here in the Dixie, in the DXY, and the 10-year was elevated. It's kind of fading back again towards that 383 quarterly level. So what do we got this morning that is up? Semiconductors, consumer discretionary. That's a little bit of the Tesla rebound. Nat gas, China ADRs. All right, we can see JD is up this morning. It's range bound completely. We needed to get above 37.38. Then we could focus on 38. Nice round number. There is a gap to close up there. $38.14, but it's got to get out of the box, right? And you know, the thing is, we have that weekly candle measured, and 50% was the line in the sand. We're right there, 37.23. I'm more inclined to believe that we're going to come up and hit our head on that thing, roll over, and continue to the downside. I don't see this making the breakout and making the continuation, but we'll see. That JD, PDD. Now PDD is above that last week's 50% mark. We can see it 75.29. We're still inside day. So for PDD, we'd need an inside day breakout. Target back up to 79 would be a good start. This is a failed TRB. And, you know, if we were to consider it an IX10, which we're not going to, that would be a really wide, really nasty IX10. So those China ADRs may be up this morning, but so far, not impressed. Baidu as well, 50% mark, same thing. We are a long ways away from it, and now we're underneath that 10-day moving average. We are flirting with the 20-day, which is sideways anyways. I don't know, man. These things just look weak. And Baba. Same thing, 50% mark. We're above it this morning. It's nearly around number 93.01 is close enough to 93. If we continue to hold above it, we got to get the breakout above 95 and we could target 97. Otherwise, we're still just stuck inside of Wednesday's levels, right? And we are back above the 10. That's a really steep, very sharp 10. But we're back above it. Nothing in the airlines. Getting a little bit of movement out of the pot stocks this morning. Semiconductors are getting a little bit of attention. That's going to go into that box, right? For could we rally and have a bullish day today? We've got semiconductors on the move, and technology names are getting a little bit of attention. So we can see the FANGs are right at my 50% mark. If we were to look at, right, my little homemade version of the NY FANG. So tech stocks, semiconductors, you put those two together and say communications names, you can throw those in there. Just kind of broad tech and junior tech, and you know, you've got healthcare tech. It spreads out all over, right? So definitely tech. Bitcoin stuff is looking a little light if we're only looking at BITO. Yeah, we're certainly not getting much attention out of the Bitcoin names, but Bitcoin itself was up mildly this morning, not crazy exuberant, but it was up. So we don't have those Bitcoin proxies. We don't have them this morning. Tesla's moving that consumer discretionary sector, so it's up, but very likely it's only up because of this. with the move that we've seen in US dollar Japan, you got to have an expectation that silver and gold and miners are down. They were down. Silver's already starting to try to turn that around, take things back in the other direction. We're still very far away from the 10-day. GLD is still down. We had an inside day breakout, managed to recover, but that's not saying much. Let's talk a little bit about what we could get out of these things. So we had the pop in US dollar Japan that surged everything higher. And if we look at yesterday's sell-off in something like GLD, after this nice little run up, having that pullback would kind of give us a springboard, right? So we're IX10 inside of this really big day. That's not exciting to be range bound inside of a big day. But we could go red to green, right? R2G is a strategy. It sounds simplistic, but it's a really good strategy. Usually it's an intraday thing for me, but you can use it on the higher time frames like a daily, weekly, things like that. But it's literally called R2G. Start searching for it. You'll find information on it. From an intraday play, when it comes to R2Gs, I usually like to pair it up with something like, say, analyst revisions. So suppose an analyst comes out and says, I think Ford is way overpriced, it's too expensive, and it doesn't match its valuations. They kind of poop all over Ford. And so Ford dips in the pre-market, and then in the open, it just starts running to the upside. It bucks the system, right? Throws off the analyst revision, and everybody starts buying it anyways, even though it was just set to a hold or maybe a sell by an analyst. That kind of red to green is a really powerful one. I like that one. So it's something to think about. Analyst recommendations, I don't care what they say, right? If they say it's a buy or they don't say it's a buy or it's a sell, whatever, I don't care what they think. But I do care about contrarian moves, right? So if they say it's a sell and everybody starts buying it, that's a play on the day. I want that one. You can find analyst rate changes on the use the news. I mean, there's a million ways to find that, right? It's free on YouTube. If you just type in analyst rate changes, I think there's a Bloomberg list or maybe a Yahoo list. There's certainly a million ways to find it. So I like to play that contrarian. But every once in a while, they'll come out with something really good too. They'll do an analyst revision or rate change with a really great write-up, giving a perspective that makes everybody reconsider. They did that to China Education Services. I can't remember the name of the company, but they dogged all over the one that was leading, and they listed one and talked up one that was really kind of a nobody at the time. And it was a drastic change between the two companies. One got sold off really hard, and the other one got bought up really big. But it was a full article, not just a headline, right? And in the article, they explained how this one company was just dropping the ball and parents were upset. And it's a whole deal. So don't discount those analyst rate changes on the face of it. Don't just use the headline, read the article. TipRanks is a company that has data points on all of its analysts. It keeps track of what they recommend and how things happened after their recommendation. I like that because a lot of those are shady, right? They'll get a call from a broker and the broker will say, hey, we're trying to dump Ford, talk it up real good so we can sell it to somebody, right? Well, I mean, that's shady as hell. So having analysts calls monitored to see, what the follow through was, being held accountable, I like it. So then you can see who's got a good track record. It's not free, of course, but it's called Tip Ranks. It's worth checking out. You know, if you're a longer term trader and you've got kind of an empty portfolio looking for new things, maybe that's worth looking at. Sirius XM was in a short squeeze yesterday. It's very likely that the squeeze isn't done yet, but that was a phenomenal move, right? From a this was on the list for wheels. We were doing wheel trades with this about 2 years ago, a year ago. And meets the criteria, right? It's really cheap. It's got weekly options. It normally doesn't have this many strikes, which is, you know, that big move kind of shook everything up in here. But if you were running the wheel in this and you were short on the call side, you just got annihilated. Hold on though, right? Don't try to manage your trade at this point unless you want to roll your calls up. Otherwise, if you're looking at a wheel strategy, selling calls at $8 in Sirius XM is not a bad idea, right? Go out about a year. Otherwise, in the short term, you're probably just going to get run over because, like I said, the short squeeze likely isn't done yet. But give it a year. That was a phenomenal move to the upside. You can see how it started earlier in the week, and it's just been following through. Those shorts are getting eaten alive. Here's a chart going back to 2004. You can see that $10 is kind of a ceiling. So, you know, I'm not going to say that it's a guaranteed you won't lose kind of trade, but selling calls at this point looks pretty darn good. We'll look at January 2024. It seems like I'm not the only one thinking about that $9 and $10 area. Usually a stock split is the reason for strikes that look like this, right? Where it's 935, 975. It's not a full number. Focus on where the open interest is at. And then focus on how much money you could get versus where you would be obligated to provide stock. Normally we start a wheel strategy by selling puts, right? But you don't want to be selling puts in Siri right now. No, Siri, go away. In Sirius XM. Remember the contract, right? If you sell a put, you're entering into a contract that says you are willing to buy the stock. If you sell a call, you're entering into a contract that says you are willing to provide the stock. If you don't have the stock, then you have to do it cash secured. So one thing that you could consider doing is just buying the stock. I don't recommend that. And then selling the call, or just selling the call. If you are uncomfortable selling that call naked, by the way, you could come in and sell a call spread. The $9.75 strike has a very narrow bid ask, all things considered, right? And the 12 strike, I mean, there's nobody there on the 12 strike, so maybe the 11.75. If that was your call spread, you're looking at a $2 wide spread, you're getting $1. That those numbers aren't right. Never mind. That's what you would want, right? But it's pre-market and there's no way you're going to get $1.50 credit in a $2 spread that far out of the money. Those are just inappropriate values. They're not, don't trust those. But that'd be the idea. This happened to Kroger a while back. I think maybe it's probably been over a year now, but Kroger was a good one to do that with. That was the first place I ever worked as a teenager. So you can see back here where it had that same situation. So hopefully I give you a little something to think about when you see something like that short squeeze in Siri, right? I know a lot of people say, oh man, it moved really fast. And by the time I found out it was happening, it had already made too big of a move and I didn't get any of it because they just wanted to buy a call and run it. Hey, I get that. But that doesn't mean the whole ship has sailed and there's nothing that you can do at this point. You still make money on this thing. And by the way, the reason I mentioned going out farther in time is because I don't think the squeeze is done yet. It might be. I mean, this could be the end of it and it just falls back down from here. But on the other hand, it could still keep going. And for how far it could go, well, remember $10 is kind of the ceiling on this thing going back 20 years. So, that's kind of going to need to be our line in the sand right now, is that it probably won't go more than $10, to the $10 level. So what are the costs of calls sitting around the $10 level? 14 days out, $10 calls. We're not getting any prices this morning. Yeah, there's nothing there at the moment. Oh, okay, there's some. 75, 80 cents. Yeah, I don't like that. Puts right now should be not too extreme, right? January 2024, $4 puts, split the mid. You're looking at what, 50, 60 cents maybe? Yeah, 56 cents. That would be something to consider as well. You're risking 30 cents for a chance to make 70 cents. It is a debit, so there are a lot of ways to approach this. Anyways, kind of kick it around, right? Sirius XM, that was a heck of a squeeze. I don't think it's done, and could get some more opportunity out of that, right? I like it as a short, however you want to short it. Just don't sell puts in that thing, right? Don't do that. We are primed for a move today. I kind of want to knock on the table on this one. We've got tech and finance and consumer discretionary, and those are the three sectors that we focus on for a risk on day, right? Is it going to be a rally day? Do we have the three sectors on the top here? And that's what we have today. Now, it could be a rug pull like we had on Wednesday, a little bit of shaking and where they trick us out a little bit. But in the last 5 days, consumer discretionary is down 2%. That's because of Tesla. Technology is flat. So, in the last 5 days, it basically went nowhere. And the financials are up 2.5%. If today's a rally day, that'd get tech back in the game, back up to that TRB move would put us up to like 182. And consumer discretionary could get us back up to like 178. We're above the 50% level of yesterday. So you can see here in the ES, 45.75 and 3 ticks is the line in the sand. It's yesterday's midpoint. If we continue this move to the upside, the RTH cash open of yesterday is going to be a level to focus on. It's a pivot point that most people ignore. Then there's the Globex low of yesterday. We just got through that zone. Yesterday's Globex high and then yesterday's high. They're both close enough together that I would merge them into a single pivot point. They're only 1 point different. Let me check spot gamma real quick on their levels. $45.50 and $45.65 is the SPX short-term resistance. SPY is 455 call wall, and short-term support is 4,500. The gamma model has us right in here, right? That 45.51 strike. Wow, they need to rethink that color scheme. So next week, Microsoft, Google, Visa, McDonald's, and UPS earnings. And then Coca-Cola and Facebook, Apple, Amazon, Intel, and MasterCard. That's a big week next week on top of the FOMC. And Wednesday's GDP. Here's a great chart if you want to snatch a picture of that. Bearish above, bearish below. It's not looking good either way, right? I'm almost done. I've got to check one thing and we'll wrap it up. Of course, now I can't find it. So what I was looking at here is the spot gamma index. All right, there it is. I guess it's written right there on the screen. So when this is large positive reading, traders might find edge in playing for the smaller mean reversion trades and premium selling strategies. All right, so it's like you sell into strength, buy into weakness. Large positive readings is a forecast that future realized volatility will be relatively low with smaller trading ranges. So when this number is big and positive, you expect the range. And when it's large and negative, you expect the moves that we've seen earlier in the week where we had those big breakout days and we really had an expansion day. This is saying range, right? Now that can change. It's just our projections for today. So this is saying that for today, we're expected to stay range bound, but the markets are waking up. That's a heck of a move. We haven't even got the data yet. So they're front running it a little bit. And we still have OpEx at the end of the day. So everybody be careful, be safe, have a great weekend. And I will see you all next week.